to Real Estate Mindset, and good morning. Welcome to Friday Mornings Live. I have Jack with us from Nobody Special Finance. Sir, Jack, thank you for being here. How are you this morning?
I'm doing good. Thank you for having me on. It's always a pleasure to talk with you, Travis, and I am looking forward to today's video. I have one question, though. Will today's live stream be bonkers?
Jack, do you like asking rhetorical questions, sir? Because you know it's going to be absolutely bonkers. You know that already, Jack. Do me a favor, guys. Like the video real quick. Go over to Jack's channel, Nobody Special Financing. I'm sorry, finance. I said that last time. Financing. Nobody Special Financing. You're not financing, but
you're off brand.
Finance. So we're going to get started right away, Jack. I want to go straight into the housing market update. Now, what I want to show you guys real quick, and this is where we'll start, is I want to just bring up once again the fact that we are still in a huge bubble in the housing market. Still a lot of people out there that are saying we're not in a bubble and everything's okay. Housing market's super strong. So I'm going to pull up, and you guys have seen this chart a couple times. I want to compare the Case-Shiller Home Price Index and compare to CPI. And really, it should be an indication, Jack, at least I think. I mean, the PE ratios, the price to earning ratios, the PE ratios right now, historically not sustainable. From a historical aspect, we cannot sustain these prices unless I get a 60% raise, you get a 60% raise, our viewers get a 60% raise, but I have about a 20%, maybe even more decline in income. So I really need an 80% raise. Either way, I think it's really good, and I want to get your opinions here. Okay, I apologize for that. I'm going to get your opinions here real quick. Here we go. Okay, guys. So what we're looking at here, again, and is the Case-Shiller, and we're looking at CPI. The Case-Shiller is a home price index. Okay, that's in red. The CPI is in black. And I want to draw your attention first to the bubble right here. Y'all could see that this is basically the great financial collapse bubble. Okay, so obviously it went way above the black line, and then it went, obviously the housing market crashed down, and it got a lot closer to that CPI. Now, pretty much the entire world can acknowledge, Jack, this is a bubble right here. So again, if everyone's acknowledging this is a bubble, then we should acknowledge the fact that this is what would you call it, a juggernaut of a bubble right here?
Y'all, the bubble within the bubble, yeah.
This is a double bubble. Do you remember that game, by the way, from Nintendo, Double Bubble? I could never beat the boss, dude. I almost beat the boss like 3 times. I could never beat the boss. It is what it is. But, again, guys, this is really important. What we really want you to understand here is the risk, okay? No one's going to force you not to buy. No one's going to force you to buy. But understand that buying real estate right now comes with a tremendous amount of risk, because not only do we have the elevated interest rates, which relatively low when we consider things, even though the prices are high, but the prices still haven't gone down to a level that, in my opinion, is sustainable for the average American. And that's really what we're trying to warn you guys about. Am I wrong there, Jack? Do you want to add anything?
No, I would add, you're definitely not wrong. I am in firm agreement that we are in a bubble. Now, there are some housing bulls left out there. Two in particular, 2 guys that I follow, Joe Brown from Heresy Financial and a guy on Twitter, X, named the Happy Hawaiian. And these are both really sharp guys, very well informed, very nuanced, data supported opinions. And they're still housing bulls.
Yeah.
And they're generally saying because there's a housing shortage, that's why we're not in a bubble. And there's reason to that argument, and their arguments hold water. We do have a housing shortage. We've underbuilt for so long, but a speculative asset bubble and a shortage, I'm not sure those two are mutually exclusive. To your point, the affordability metrics being just blowing out all-time highs, that is by definition a speculative asset bubble. People buying Airbnbs just expecting magic cash flow to appear, because as long as I buy an Airbnb, I'll make money, and then I borrow against the Airbnb to buy another Airbnb, borrow against that one. You do this laddered leverage thing. That is a speculative asset bubble, and that is everywhere in this market. So I think both sides make valid points, but I don't think they necessarily cancel each other out. I think we can have a shortage and a bubble at the same time.
And I listen to, I listen to him a lot. It's Heresy Finance, right?
Yep.
I used to listen to him a lot, man. And I heard, I think he did a house market video a couple of weeks ago, maybe 2, 3 weeks ago. And yeah, I was really surprised his take on the housing market because I've agreed with a lot of what he said, especially with the bond market and the yields. But I was surprised, man. A lot of people are saying, even though, again, when you look at the PE ratio, the equity run up, talking about the bubble here, that it's not a bubble because of the historically low active inventory. But one of the things that we're seeing, and one of the things that I showed on my video from yesterday, is the amount of off-market inventory that we actually have. And I'm not just talking about new construction, new home inventory. We have way more inventory than what America realizes. And I'm going to show you guys that a little bit later on in this video. Basically, Jack, yesterday I went out to a new build community. It showed 8 active listings on MLS, 8. When I got there, there were 17 homes available. So that's a double up from what's reported at MLS. Plus, they had additional homes that were being worked on for a total of 23. So I think there's a lot of inventory. And then plus, we also we're seeing cracks in other areas of the housing market where we're getting more inventory now, where once we were losing inventory, one of that being institutional investors. Most of the biggest landlords in America, SFRs right now, are turning into net sellers, which is helpful. Not to mention, we're also going to start getting and are already getting massive amounts of inventory in the metro areas that have banned STRs. And that includes VRBO and Airbnb. So we're getting it there. I think also what's interesting, Jack, is there's also bulls. So not only the inventory, like people are like, where are we going to get the inventory? I have 8 different places that we're going to get inventory. But another question is where that I hear from the bulls is, where's the forced selling going to come from? And, and they say that like, oh, I got you. Where's, the reality is the existing homes and new homes. First of all the new homes is for selling. They have to sell in any market. But when we look at the existing homes right now, and we look at the survey that Zillow just did on why people are selling, we can see that a minimum, Jack, and this is crazy, minimum 30% of active listings in existing homes right now are forced selling. So my other question is this. Once interest rate, I don't even think we need rates at 5% for people to start selling. I think if interest rates go maybe low 6%, that the people on the sidelines that want to sell, they're going to come back to the market. I think we have hundreds of thousands of homes on the sideline ready to be sold. The question is will buying demand be wrecked and exhausted by the time interest rates go down and inventory goes up? And that's really what I think that the Fed is kind of doing, that balancing act right now over. But yeah, I mean, I heard those arguments from some of those bulls, and a lot of it, again, it has to do with the inventory. But then I'll add this last thing, Jack. Okay, so we all know the prices are high, right? The PE ratio is out of control. That's a result of the low inventory. So if we get just a little bit of inventory back, those prices that are sustained because of the low inventory, there's a probability that not only are the prices going to correct and go down, but there's a probability that it will crash, especially with the 2 unknown things, a deep recession and unhinged unemployment. But the inventory is something that we've been watching for sure. Anything you want to add to that before I kind of get into the market analysis?
I would mention the important phrase liquid or liquidity, right? Because the real estate market is illiquid right now. There's not many transactions happening, not many buyers, not many sellers. And illiquid markets are notoriously volatile. They can't easily absorb any deviation in supply or demand without big price moves. And we kind of saw that in the bond market this week. Our bond market is historically very low liquidity levels in the bond market right now. All the biggest buyers historically are now sellers, like the Fed, Japan, and China. And then this week, we had a little bit of new sellers come into the market. We've had the government is issuing new supply of bonds. And so interest rates, the price of the money, started skyrocketing. That's bond prices falling. Bond prices fell very rapidly because we had new supply come into the bond market from people selling after what Jerome Powell said. And, because we had low liquidity levels in the bond market, we had these big moves in interest rates. Housing is going to react like that to any new supply coming into the market. Now, I think we talked about this in the interview we did recently where I talked about the job market. I think the deluge of new supply caused by a wave of unemployment is probably still several months away. I think the thing happening with Airbnbs and short-term rentals, probably the same thing. People don't sell right away when hard times hit. It takes several months. They sell other things to hang on to the house a little longer. I just need to get by a few months. I'll be okay. Then they go bankrupt, and then the foreclosure starts, and that takes a few months. So I don't think necessarily next week is the housing bubble crash.
Yeah.
I could be wrong about that, but I
I
do
don't
think
think
it's inevitable.
it takes time, Jack, and I want you to remember what I'm saying now. You have a great memory, unlike me. I think it's, even though you have as many children as me, I don't know, some people are just made with a great memory. I am not. I'm the only thing I'm great at is embarrassing myself. And sometimes I'm not even great at that. But remember, you heard it here first, okay? I suspect we're going to have, an unprecedented amount of inventory come into the fall and winter months of this year. I mean, if we look back this entire year, inventory never really went up. Never went. It was pretty much the entire time, pretty much sideways. The fluctuation was in the buying demand, not the inventory. It's crazy if, again, you look at the charts, the inventory was sideways. I think and again, you heard it here first. I think we see another 100 to 200,000 active units before year end this year, as a result of some of the crosswinds. Like, again, the STRs. I don't know if it's going to hit every metro area, but we already have it in New York, Las Vegas, and Dallas. And New York started enforcing. And I think that's the domino effect that the rest of the US needs to see to start the enforcement on STRs, whether you agree with the STR crisis or not. If there's no enforcement, then the laws don't matter. So now that we're seeing that, but you hear it here first, as crazy as that sounds, Jack, and it's never really happened before. We've got winter inventory like that, except last year, up until I think we're getting inventory up until October of last year, which is also unprecedented. So I think it's going to happen. Something similar is going to happen this year. I'm going to get started on our market update.
Sure.
Really value your time, Jack. I'm going to try to make this fast. My pen ran out of ink, of course. So embarrassing. So I'm going to start by talking about the VIX. And what I'm going to do actually is I'm going to pull it up on our screen like this. So they can also see us. So I want to bring up the VIX because I talked about this, I think, a couple days ago. And basically, Jack, what I said is this sucker is historically low, which is an indication that the economy is historically in great shape. 2 days later, it goes up 30%. So I think the market, I think it's starting to kind of wake up. But I do want to point that out, guys. When I was talking to y'all about this, I think 2 days ago, it was in the $13 range. Y'all, this sucker shot up to almost $17. It's up right now from 5 days, 22%. So I just, some of the markets got it right, maybe. Some of the markets got it wrong, but keep your eye on VIX. Now, one of the things that happened as far as the 10-year going up, 10-year obviously shot up. Now, obviously, when the Fed said higher for longer, me and Jack talked about that. But another thing is the U.S. applications for jobless benefits somehow fell to the lowest level in nearly 8 years. Now, that topped with, again, what the Federal Reserve said, higher longer, shot the 10-year up drastically. And actually, y'all, yesterday, this ended up at 4.5%. I think it was 4.5%. And what I want to really explain to you guys is how historically high this is. The last time it was this high was in the middle of 2007.
July or June of 07. Yeah.
Yeah. And then I see your question, Island Eric. STR stands for short-term rental. So short-term rental is VRBO and like Airbnb. That's what STR stands for. So anyways, here's this skyrocketed upward. Let me show you the mortgage rates. Okay, so now mortgage rates also shot up and skyrocketed yesterday, Jack. We're sitting at an average of 7.47%. But I'm going to tell you guys right now, and remember on my live stream yesterday, I suspected this was a hit around 7.497. This is actually what I would suggested it would go to. However, what I did not expect is the 10-year to go up, 12, 13 basis points yesterday? So what I'm thinking, Jack, is even though the 10-year went down right now, you guys can see the 10-year down right now, as long as it doesn't go down too much, it's down about 4 basis points. I don't think that yesterday's mortgage rates fully priced in the increase to pricing. I believe we're going to go into the weekend possibly at 7.5 or higher. Again, just depending on what happens with the 10-year, okay? Because again, they don't always update this in time to basically account for how high that 10-year went. So I think it's going to go up. Let me show you, Jack, real quick on our last high. So our high for this cycle, right? Obviously, we've had 18% interest rate, but for this cycle, our high was at 7.49%. That was recorded back on August 22nd. So 1 month ago. So 1 month ago, our high was 7.49. It's now 7.47. So the interesting thing is even though the 10-year, right, is like a new record for this cycle, the mortgage rates are not. And again, I suspect that this will basically continue to go up depending on what that 10-year does today, being down 4 basis points. Now, what I want to do is let's talk about the power of interest. And I'm sorry for rambling, Jack. Now, I wanted to show the audience basically how these amortization schedules are working, Jack, when compared to like the higher interest rate. Basically, the higher your interest rate, the easier it is to pay your loan down to 25-year loan. Okay, so again, the higher the interest rate, basically the further your $20,000 would go. Now I put the average stats right here, $328,000 loan, 30-year fixed rate mortgage. It doesn't say fixed rate. But anyways, here's our average interest rate of 7.47%, okay? You would pay back, this is insane, not quite 500,000 yet, Jack, but it's gonna get there at this pace, maybe even on Monday when I do my next live. But right now, the average house, average down payment, average loan amount, you're going to be paying roughly over the life of the loan, almost $500,000 in interest. Okay. Now, what I've been explaining to my viewers is how important it is to put money towards your principal after you close as opposed to a down payment. The reason why I'm saying down payment is separate is paying after you close affects your amortization schedule. Paying a down payment affects your payment and qualification for that loan. But I'm attacking amortization schedule. So when I first started doing this, Jack, it took about $20,000 to get past the 5-year mark. Okay. So it took $20,000 to get past that 5-year mark. Right now, with the interest rates going up, it only takes, y'all, and you remember yesterday, I'm like, we're going to break 18,000. It only takes to get to past that 5-year mark, $17,748. It's really cool to see that number go down. It's really awful to see the rates go up and price is not correct. So that's awful. But y'all, it's only taking now $17,748. And if we go to the year six takes about $22,000. So $22,000 gets us now past year 6. Astonishing, y'all. Now, again, you would save, if you did this, you would save interest for the first 5 years, which would total now almost $120,000. We're sitting at $119,451 savings over the life of the loan. And this is the power of the amortization schedules. This is what anchors people into that rat race, right? That you can, never get out of debt if you just keep refinancing into these amortization schedules. Again, the key is pay this sucker down after closing. All right. Now, almost done here. Let's see how much it would take for the average person to afford that. All right. So right now, this is what we're sitting at as far as 7.47% interest rate, getting the average loan amount. And this is linked in all of my videos. Remember, change the debt to income ratio on the bottom here to 45%. You'll get with a loan officer if you want a true pre-qualification. But right now, Jack, it takes $120,000 average salary to afford the average price home. Is that crazy to you? 120? So we're at $120,000 salary, average home. And again, this is the average debt. And I hate to say it, maybe not the people watching us on YouTube because y'all are smart and trying to empower yourself and you're trying to learn. But the average person is not like that. And it's sad. And that's why I tell you, good teachers make other teachers. And those other teachers help the community. Your friends, your family, they're all living in misinformation. They're all living in foolish optimism right now. So the average person literally has, and I don't, but the average person does $1,400 monthly payments, takes you $120K. Jack, is $120,000 yearly salary, is that, maybe you're a baller, but is that a lot of money to you?
For a YouTuber, that would be a lot of money. Let's put it that way. For a nuclear engineer, that was not a lot of money. For a YouTuber, it is. And for whatever reason, I went from nuclear engineer to YouTuber. But we're not talking about my intelligence here. We're talking about median salaries.
Now you're just bragging. Yeah,
real quick, I just did a quick search. The median salary in the United States right now, at least the one that Google spits out, is $69,392. All right. So. Okay. You're talking to afford the average house in the U.S. requires almost double the median. It's not quite the average, but that's where most people fall. Requires almost double the average salary. So there you go on the affordability thing. I mean, homes are half as affordable as they should be right now. Either home values need to come down, or interest rates need to come down, or wages need to rise. One of
Yeah.
those three things must happen. The Fed has told us they won't bring rates down. They're trying to make sure that wages don't rise. So what is the most likely outcome here? Home prices come down.
I mean, it's not like the Fed's not fighting the labor market, right? I mean, if the Fed, if they're still printing the PPP loans and all of this, okay, yeah, maybe we'll get to the wage increase. But dude, they're literally trying to put the bedrock of these prices on consumers that are falling apart. They're burning at this, they're burning alive with these expenses. But I put your salary right here, right? So I put the average salary about 69,393. Average debt counting school loans, auto, credit cards, and that's not even a new car. New car, this would be higher. Dude, look at this. You see this? So the average American qualifies for a house that's $155,000 house. Where are you going to find that? Where do you
I
find
don't even think you can park a
155,000?
double wide in a campground for that these days. Like
I mean, maybe a mobile home park. I don't know, but it's a huge crisis. Now, guys, let me show you CME, and then we're going to get into our first video. Now, really the only thing I'm looking at on CME right now is June. And the only reason I care about June, Jack, is I've already seen this show before. The market's like, oh, we're not going to hike in November. We may hike in November. I don't even care anymore. The only thing that I care about this time is that we make it through 2024 home buying season, which we were not able to do this year. This year, it drives me crazy, Jack, because if we would have had the elevated 10-year and mortgage rates at the beginning of this year, the bubble wouldn't have magnified and trapped a whole bunch. 4 million additional Americans are going to purchase this year. So the thing is, if we could make it stay elevated through that buying season, I think we're going to be just fine as far as seeing that price decrease. And that's why I'm only looking at June, because June is 50-50, Jack. June's a little bit stronger than 50-50, and I like that. So, and obviously the rates haven't increased yet, so we're still at 525 to 550 right here. Okay, so that's all I'm looking at. And right now, the market is saying we have over a 50% likelihood of staying elevated in June of 2024. This is a great thing, but barring what? A black swan event. Obviously, if a black swan event happens, I mean, look at what happened this year. We took several steps back as a result of that bank bailout. Now, hopefully, it ends up being a good thing, but obviously, I kicked the can down the road. Now, Jack, before I enter our first video, which is going to go into the bond market, you want to recap on any of that?
Yeah, the thing about the CME futures that you're looking at there, keep in mind that is based on interest rate futures, what bets the bond market is making about the Fed's overnight rate, right? So mortgages has more to do with the long end of the yield curve, like the 10-year treasury versus the overnight rate or the 1-month treasury. The Fed can only directly control the short end of the curve. So what we've seen in the last few weeks, or really the last few months, even since, say, the debt ceiling was suspended, the Fed has not moved very much at all. They hiked once or 25 basis points, but the short end of the curve has barely moved. The overnight stuff, the 1 month has barely moved. The long end of the curve, though, has risen substantially, and that is what drives your mortgage rates. So the Fed does influence the long end of the curve, but not as much. So when you're showing the CME tool there, keep in mind that's just the overnight rate, and that's the short end of the curve. The Fed has much less influence over the long end. The Treasury, the U.S. government, has much more influence over the long end of the curve. And right now, the U.S. government is issuing a ton of new bond supply with all of their $2.2 trillion deficit they're running. So with what the Treasury is doing, there's a very good chance that the long end of the curve is substantially higher by June. The only way it would be lower is if we get a return to something like the banking crisis we saw in March, and that causes people to panic and go hide in the bond market, which would lower rates. And of course, if that happens, the banks won't be making home loans, that's for sure. So
yeah, I mean, and the thing is really the reality here is stay doing the quantitative tightening, even though technically the rates is, I guess that's not really considered quantitative tightening. The balance sheet is, right? But stay elevated. Stay elevated. We already see what happens with the consumers, man. You know, the bank bailout, rates only went down a little less than a full percentage point.
Yep.
And look at what happened to the housing market. Look at what happened to shelter inflation. We see it in CPI. We see it in all this stuff. I don't know. You're smarter than me, Jack, but I wish people would just hold on for a second. You know what I mean? I would, because, and I went into a new home build community yesterday, and I asked the sales reps, I'm like, how many times do you guys get a naive buyer that comes in here without realtor representation? And they looked at me, Jack, and they smiled and they said, most people come in without a realtor, with no knowledge, buying houses with emotion. First of all, I can't believe they admitted that to me. They had no idea who I was, but dude, the consumers are in bad shape here. Most people don't even know what the federal funds rate is.
Yep.
How do you?
Most
how
people
do you?
couldn't even tell you what the Fed is or what the Fed does, even though they're pretty much the most powerful people in the world.
So how do you? I mean, the hard part is I think as a content creator and an influencer is how to simplify so much complicated information so that our viewers can not only understand it, Jack, but they can take it and they can grow from it. And that's why I like you so much, man. You the way that you explain things are very good. Obviously you're a nuclear scientist. Is that correct?
My degree is mechanical engineering, and I spent 15 years working in commercial nuclear power. So nuclear scientist, nah, I can't. I'm not quite that geeky. As they said in the Big Bang Theory, the engineers are the Oompa Loompas of science. So that's
So
that's for
humble.
me. Yeah.
You
I'm
guys,
an Oompa Loompa.
he's a nuclear scientist. I'll just say it. Maybe not officially, but you're my nuclear scientist, Jack. So,
Oh,
do
thanks.
what you want with that.
You're making me
All right,
blush.
guys, we're going to go into our first video real quick. This is going to be on the bond market, a little bit bullish, but let's hear what they have to say.
Government debt issuance fit in?
Well, listening to our two guests, all I could think about is that one of the biggest reasons why interest rates are going up is because the government spends ambitiously, and they continue to spend ambitiously. I think this is a big deal, and we need to pay attention. And you could look at the Fed and the Rorschach and try to figure out where rates are going to go, or you could just pay attention to the data and the fixed income treasury market. It's been telling you what to do. Let's look at initial continuing claims. Both today were at 10-month lows, 9-month lows, going back to January. And if you look at 2s, 5s, and 10s on one chart, it says it all. 2s are basically slightly lower yields on the day, like the 3-year is. If you look at 5s, they're up a couple of basis points. 10s are up about a half a dozen basis points, and 30s are up about 11 basis points. And if you consider right now, put them all on one chart, 3s, 5s, and 10s go back to 07. I'm going to do this quick. 02s go to 06. 07s were started in 09, so they get back to 09. 20 years started in 2020, so it's at the highest yield since 2020. And the 30 is at the highest yields on a closing cycle basis since 2011. It's been very clear for a month that these long-dated treasuries and the steepening curve were the underpinnings of investment activity. So the Fed could say what they want. You could try to mind their crystal ball, but in the end, I think they're watching the markets a whole lot more closely than many think. And it's very difficult in the end to understand what the dots truly mean, or to say we're going to have all this easing in the future. The only thing that matters in the here and now is that the market's guns hot on rates, and even though the UK didn't raise rates, it doesn't matter at this point, because they didn't raise rates because their rate fell, a couple of tenths to around 6.5%. These are still too high globally. Spending, inflation, energy, and the Prime Minister of England, what did he do? He pushed back 5 years the forced transition to EVs, and embedded in that is one of the biggest inflation problems the globe has. Tyler?
All right, Sir Jack, care to comment on that?
Well, first, let me say Rick Santelli is one of the few voices on CNBC that I can stomach. I'm not a big fan of the network. Santelli, though, he's him, Scott Wapner. There's a few others. Their names elude me at the moment, but I like Santelli. I did notice he kind of touched on something similar to what I was saying about how, hey, it's the long end of the yield curve that's more important here, guys, that the further out you go, we've been getting bigger moves recently. And, your borrowing costs, the actual effects felt by the economy, what you pay for a car loan, what you pay for a home loan, your credit cards, it's got more to do with the long end. So the Fed can talk about the dot plot and the overnight rate until they're red in the face. They don't control the long end, at least not directly. They can influence it, but they can't control it. And that's what you need to watch. And that has been the big move this week, has been that long end of the curve. So, another thing I want to throw in is that we're seeing the spreads increase, right?
Mhm.
You've got the 10-year yield, but the
Yeah.
premium that a 30-year mortgage charges for the 10-year yield has been rising also. So as the 10-year rises, the 30-year is rising even faster. The 30-year mortgage is rising even faster. So I think when we get a few more updates on these mortgage prices, interest rates that you've been showing, I think
Mhm.
we're going to see some pretty substantial moves higher in the next couple of weeks.
Yeah, I agree with you, brother. Um, Also, man, I was going to ask you a quick question. Do you have any animals out of curiosity?
Chickens. I got a whole
You have
farm.
chickens.
I got chickens. Yep.
I can't believe you do. So do you do the eggs and all that stuff?
Oh yeah. Oh yeah. Yep.
Really?
Me and my
You have a
girls, we have a little
garden.
chicken operation. Yep.
That's so cool. Do you have a garden?
I do. Fun fact,
Awesome.
everything I planted this year died.
Oh,
But everything, I call it my once through garden because I set up this whole big flower bed and I fertilized it with my chickens leftovers, if you will. And
yeah.
up from that came corn,
Yeah.
pumpkins, tomatoes, sunflowers, all the stuff I fed to my birds and came out the other end. That did great. Everything I planted and watered died. So
Y'all,
I'm
this
a
is why
lousy gardener, but I'm good with birds apparently.
I love Jack so much. I mean, we're dealing with a nuclear scientist that's out playing with chickens in his backyard with his children. That's the type of person I want as my friend. I'm just saying. Jack, I'm gonna get into this right now, my brother. And since you're here, I'm gonna pull it up like this way. Now, looking at the reverse repo market, um, so good points. That Jack makes some really, really solid points. He's really, really on top of the bond market. That, if you guys want to know more about those details, again, go over to his channel right now. And while you're at it, like this video. But essentially, what's going on is people are selling those long-term 10 years, right? China, whoever, foreign. And as a result of them selling those long-term yields, probably going into shorter-term yields, it's driving those interest rates up. Is that correct, Jack?
Yes, selling bonds puts upward pressure on rates. So when you see 10-year
The opposite.
yields rising, people are selling 10-year bonds. Yep.
It's actually crazy as it sounds. It's the opposite. But take a look at the reverse repo market. Now, after the CPI came out, it started shooting up. Dot plot came out. Now, this went down slightly. I believe that the money's sitting here until the Fed's done. I think this money is going to be gone within probably a short amount of time. Once the Fed says we are done raising interest rates, I think that money goes into the longer yields. Longer term? What do you think, Jack?
The thing about the reverse repo is it's an overnight rate. It's ultra short-term lending. So I think the Fed they're yielding like 5.3% right now, or 5.25 you can get in the reverse repo. So this really has more of a direct impact on the short term, the short end of the yield curve. Like we've seen this start to go down. In particular, it started to drop really fast right after the debt ceiling crisis, which was like the end of May, beginning of June. That's when it really started to fall. Now, after the debt ceiling crisis, Janet Yellen started issuing a lot of short-term U.S. Treasuries.
Right here.
Mostly the 1 month to 3 month. And that drove those yields to about 5.38, 5.39%. So we started to see money leave reverse repo because you could get that extra 10 basis points by buying 1 month treasuries. And with the debt ceiling behind us, there was no risk there. So I think this is more to do with the short end of the curve. The reverse repo is acting as a shock absorber for the short-term interest rates. It doesn't necessarily, at least not directly, affect the long end.
What a game of cat and mouse. We know that the Federal Reserve, they don't control the mortgage rates, but geez Louise, man, when you have that much influence over money, I mean, do they really need to be, direct control of the 30-year fixed mortgage rates when they control the world? I mean, money controls the world, unfortunately, not my heart and soul. But, dude, this is crazy. Let me show you this next thing. Here's the inversion. Take a look at this, Jack. You probably already saw this on your channel. Here's the 2 and the 10. This is our economic indicator. And I just wanted to remind you guys that we do not have to reinvert to enter recession. It is possible, maybe unlikely, but it is possible that we are in recession right now. Now, normally this reinverts. Let me put the 10-year so they can see that.
Now, correct me if I'm wrong. We're in negative territory right now, right?
we are still we're 63 basis point inversion,
Yeah.
but again, a lot of people are still stuck. It has to reinvert before recession, which it's true up until we get to the 70s and 80s. We entered. You guys could see we were already in inversion, and we entered recession in 1980. We were already in inversion, and we entered recession in 1981. So there may be some people here, Jack, that are waiting like, okay, we're going to start doing things when this reinverts because that will prove recession. But the thing is, we don't know what the hell is going to happen, to be quite frank. And look at the reinversion from one day, Jack. Look at that. It went from 77 basis points in one day to 63 basis points. That's what, a 14 basis point change?
It's a pretty substantial move either way.
Huge. Yeah. You want to talk into that a little bit, Jack?
Yeah, this is a point. Again, I'm referencing Joe Brown from Heresy Financial because Joe is really sharp. I just had him on my channel yesterday, and he raised a really good point in that interview. If you zoom out on that chart again, historically, you'll notice all those big spikes in this chart, which is where the yield curve is uninverting, right?
Yes.
The yield curve. Those have historically happened because something really bad has happened in the economy, and the Fed has stepped in and drastically lowered the short end of the yield curve. Right. So that causes the curve to reinvert because the Fed pushes down the short-term stuff.
Yes.
That's not what's happening right now. The Fed is holding the short-term stuff where it is. It's actually still elevating it a little bit, but the long end is now rising very quickly. So this is more of an organic reinversion or uninversion we're seeing right now. And the other thing, that rapid uninversion of the Fed lowering rates, well, we've got an inflation problem right now, so the Fed can't do that this time around without reigniting inflation fears. So we may be stuck with this slow grind higher in the long end of the curve for a long time here, and that's where this higher for longer narrative is coming from with the Fed. We have not seen that ever. So anybody who tells you they know what that looks like, they're guessing.
This is such a wild situation that's going on right now, Jack. Yeah. And the thing is like, I don't know why the market was surprised for higher than longer when they've been telling us for the entire time, higher for longer. Right before the bank runs, you probably remember, I think it was maybe 1 week before those bank runs happened, Jerome Powell was in Congress. He was telling the American people, higher for longer. A week later, bank runs, everyone forgot. Like, geez. That's why I keep trying to tell people, like, if you're going to buy, have these few things and be safer. Now, let me show you this is so crazy, Jack. This went up. Probably a result of the labor market. Who knows? But this is the 5-year break-even inflation rate. So when Jerome Powell was saying we need to make sure that inflation expectations don't become unhinged, I find it remarkable, even with the crosswinds, right? Even with this, the turmoil happening in the economy, certain aspects of the economy, commercial real estate, things like that. This actually went up. So this is now at 2.29. Now, a lot of people are saying, Jack, maybe you could give us your 2 cents on this, that this needs to hit under 2, probably hit under 2 or 200 basis points or 2 for the Fed to start lowering rates again. But again, ever since that, I think it was a CPI report came out, or I can't remember what happened right here. This sucker's been going up. Yeah. Do you think this is a primary result of the labor market?
I'm trying to think what happened August 31st. I think oil right now is what's driving the expectations, inflation expectations, because the Saudis and the Russians have been limiting supply. Yeah. And keep in mind, these supply cuts that the Saudis and Russians have implemented this year are as much oil supply as the dumping of the Strategic Petroleum Reserve was last year. And that was enough to send oil from 120 down into the low 60s. So now we started in the low 60s. OPEC is telling us we're bringing you back to the 120s. Right. Yeah. Now, Powell addressed this a little bit on Wednesday. He was very dismissive of it. He said, I'm not so worried about oil because it's volatile, because we don't control it. I'm more worried about core inflation, which means not food, not energy, more like stuff, everything else. Yeah. Yeah. But if oil prices rise and they stay high for a long period of time, that's going to start dragging core inflation higher, because picture like your furnace repairman, he's got to send a van out to your house. And if gas prices go higher and stay there for a long time, he's going to start raising the cost of repairing your furnace that first billable hour is going to go up 25, 30 bucks, right? So that would be a services inflation going higher because of gas prices, because of oil prices. So if this move in oil sustains itself, it's going to start pulling the rest of the inflation statistics up with it. So I wouldn't be so dismissive of this move like Powell was in the press conference. Maybe he was trying to just seem confident, poker face Powell, if you will. But that oil thing is more concerning than I think the market right now is alluding to.
I guess being cautious really is a good idea, Jack, instead of optimistic that everything is going to work out, huh?
Cautiously optimistic, even. Channeling Al Gore there a little bit.
Fine, yeah.
Just a bold.
Is there such a thing as cautiously optimistic, though? I mean, yeah, I guess so. I go shark fishing at night in a kayak, so I guess there's cautiously optimistic. Now I'm going to go into our next video, Jack, right now, and I want to take you shark fishing with me. I think that would be a great bonding experience. There's nothing like fearing for your life and being okay.
It's a fishing goal. I've always wanted to catch something big enough to catch me. So yeah, that's the cool thing about shark fishing. Feels like a level playing field.
I'll get you out there, man. All right. So what I'm going to do now is we're going to listen to our second video, Jack. Now this video is going to be on assumable mortgages. All right. This is a pretty hot topic right now. An assumable mortgage is the right way, because there's a wrong way being pushed on YouTube. In my opinion, some people disagree with me. Some very smart people, actually, even attorneys disagree with me, although I'll still fight back on that. But assumable mortgages allow someone to buy a house and take over someone's existing mortgage. The reason why that's such a great thing sometimes is you get to take over the 2, 3, 4% interest rate. Okay. It's important to understand, though, is generally assumable mortgages are only on like government backed or guaranteed loans, VA, FHA, and USDA. Most loans are conventional mortgages. In conventional mortgages, you are not allowed to do an assumable mortgage. So this is really cool because this video is talking about a company now that is specializing in assumable mortgages. The reason, again, Jack, this is so important is, and I don't know why I get in this argument all the time, but there's another group of people that are doing something called sub 2 or subject to creative financing. Man, I get blowback from talking about this, but the thing is, and this is the truth, and that's why I keep talking about it, even with the blowback I keep getting. A sub 2 is where an investor or buyer purchases a house and they take over the mortgage like an assumable mortgage. The difference is they do it behind the lender's back. And the seller does not have permission to give their loan to some stranger investor. Now, the pushback that I get is, Travis, but it's so rare and we could, put it in a trust and we have all these legal loopholes and it's probably unlikely, right? But I'm like, yeah, I get it. It's really highly unlikely that a sub 2 would result in an acceleration and someone going into foreclosure. But I'm also trying to tell people, do you really want to have a portfolio built on, if a lender wants to, they could call the loan due. That would result potentially and unless you're a millionaire, Jack. I ain't a millionaire. Maybe you are. You're the nuclear scientist. And if you are, please send me a super chat. But man, it's risky. All right. That's all I'm saying. It's risky. The subject to is risky. So let's play this video. By the way, Jack, do you know the whole sub 2 thing?
Just what you've explained to me. So this is new to me.
All right. So we're going to hear about assumable mortgages. Again, I think assumable mortgages can be a great thing. I still think even if you guys buy a house with an assumable mortgage, we still have the same issue, a similar issue, which is the price. We really need those prices to go down, but enjoy the video.
Mortgage rates soaring past 7 and after today, maybe near 8%, 7.5% about, as you can see there. Home ownership has become even more difficult for many. But real estate startup Rome is trying to change that with assumable. Didn't Tyler Matheson just tell me about this?
We were asking about this yesterday.
Assumable mortgages. That means when you buy the house, you get to take over the mortgage from the sellers as well. Now, their interest rate might be anywhere as low as 4, 3, maybe 2%. Now, you as the buyer still have to cover the rest of the purchase price, of course. But here to talk about it is Ronak Singh. He is the founder and CEO of Rome. Thank you for joining us.
Thank you so much for having me. It's a pleasure to be here.
So Tyler brought this up because this used to be much more common, as I understand it, but has gone by the wayside.
Yeah. So, right now we're focused on loans that are fully assumable. So those are government-backed loans. Now, Rome helps buyers wind back the clock on mortgage rates and purchase a home with that low rate, fully assumable mortgage included. And the benefit is for buyers, they get to reduce their monthly mortgage payment by up to half compared to purchasing a home at today's prevailing rates.
Although ironically, they benefit the most if the mortgage that they're buying is very large, right? So
Yes.
like if someone only has 300K left on the mortgage and you need to take out a new mortgage for the other 300, I mean, it still helps, but
Yeah. So right now we actually focus on the homes where you see the mortgage was originated, say in 20 or 21. So the loan to value ratio is
Pretty
often,
high.
above 75%, which means that the down payment the buyer would need to make is very similar to that of a conventional mortgage, say 20% or 25%. But the value is that their monthly payment would be about half of what it would be at today's prevailing rates.
It's loan to value based on current value or the value of the property when the loan was originally taken out, because houses have actually gone up quite
Yes.
considerably, sometimes 30% since then.
Mhm.
So I may have an outstanding mortgage of 300,000 on a house that I paid 380,000 for, but now that house is worth 500,000.
Yep.
And so I've got to come up with 200,000 in cash.
Right.
Where do I do that?
So what would happen is we work with you as a buyer around what your preferences are. So if you're able to come up with the full amount in cash, we'll help you with that.
Not many
But
people
if you
can,
need
of
some
course.
support, we actually can refer you to that a second lien lender. And these preferred providers will help you calculate the savings and ensure that your blended rate is still way below the market rate.
Okay, so I'm reading in a Wall Street Journal article that the FHA has processed 3,349 assumptions in the fiscal year that ends September 30th. There must be tens of millions of
Mhm.
mortgages that would qualify for assumption.
Mhm.
Why have only 3,400 of them been done?
Yeah. So this is actually a large part of the problem we set out to solve with Rome. We found that most consumers actually don't know this is a benefit that is given to them by law.
Really?
So yes, in fact, I watched the segment yesterday. I think you had a guest on who had mentioned only certain kinds of FHA and VA loans might be eligible, or it might be an isolated incidence. And so this is a large part of what we're trying to correct the record on. It's actually all government-backed loans are fully eligible for the assumption. And this is an opportunity for most
So
consumers.
is it a question of people just not asking? Is your loan an FHA or VA backed loan? The buyer not asking, or the real estate agent not asking, so that can be listed on the write up of the property, so that
Extraction,
so that I
Yeah.
can immediately see that this has a 3% loan assumable.
I entirely agree. So there's two key issues I think that prevent there from being more attraction that we solve with our product. The first is it's been pretty difficult thus far to be able to discover these homes. Let's say you were shopping for a home in Atlanta. You would probably go to Zillow and use the keyword search function to try to find an assumable mortgage. And if you did, you'd find maybe 3 or 4 results. But if you hop on over to withrome.com,
Because it's not on there.
Exactly.
Nobody's thought to put that as a data point.
because of the lack of awareness, people don't know they should be advertising the affordability benefit of their assumable mortgage. So when you're a seller or a listing agent and you hop on over to withrome.com, we help work with you. We understand your interest rate, your remaining mortgage balance. We help frame it in the right way to the buyer so they know that your home is the only one in the neighborhood they can afford because it comes with that 2% mortgage included.
And you get paid what to do this?
So we charge 1% of the sales price. And the way we represent this to the buyer is we say, look, our incentives are aligned with yours, right? If you save money, we help you make money. And so the way we think of this is for them, the closing costs are going to be still much lower than a traditional mortgage. There's actually no appraisal required in an assumption because the loan has already been originated.
All righty. So we see now that these companies are starting to come out with helpful ways to do assumable mortgages, Jack. The assumable mortgages were really big back in the 70s and 80s, back, I think, in 1983. I think that there's a new law that was passed and said, no more assumable mortgages. You are killing us because basically an assumable mortgage back in the day when it was like unregulated, you can supersede the high rates.
It's because the banks own the politicians and the politicians make the laws. So the banks don't do that. This sucks for us.
Yeah, they were killing the banks because the banks are trying to lend 17%, but home buyers are like, no, we're not taking that 17%. We're just going to take this mortgage over here at 8%. So they changed that. It's a law. They made a law. You can't do that, essentially. Now, I thought it was really crazy, Jack, first of all, I'm happy that companies like that are coming out because that's the right way to take over someone's mortgage.
Yep.
In my opinion, the wrong way is a sub 2, maybe unless you're a millionaire and you can afford any acceleration clause. But I thought it was crazy. Only 3,400 assumable mortgage transactions this year.
Yep.
What are your thoughts on that? What are your thoughts on assumable mortgage? Oh, and real quick, last thing. You do have to qualify for the assumable mortgage.
Yep.
So it's a full process. I think it'd be 2 to 3 month process. I would do it if I find a great deal and I could get a 3-4%. I know my credit's great. I know my income's great. I don't have any debt. I'm going to try to do it. What are your thoughts there, Jack?
So a couple of things, without knowing anything about that guy's business model,
Right.
I would, go over that fine print real tight. Make sure he's not putting some kind of clause in there that indemnifies him in the event he screws up and the mortgage gets called. If I know these guys, they're slippery. He probably puts something in there that says if we screw up, it doesn't cost us anything, right? Because if you do an assumable mortgage wrong and the bank calls the mortgage, you lose your house. And if I know this guy, and I don't know him, but if I know people like him, he's probably put something in there that says if that happens, you can't take me to court, even though you paid me 1% of the home's value to do that.
I don't know if
I would check that.
Can that happen? I don't know if that can happen because the lender wouldn't, unless there was fraud, because the lender wouldn't approve the assumable mortgage unless the buyer was approved. So I think barring fraud, but then again, you're right, man. I mean, like we don't know, it could be some get rich quick scheme, but thank God at least we're not hearing people just say, yeah, just take over someone's mortgage, subject to, hide it from the lender. I mean, maybe that's the more effective way to do it, but I just, man, when people are taking advantage of loopholes, it just usually doesn't end well.
And speaking of another loophole, something that he said at the end that made me like jump out of my chair when they said no appraisal required.
Yeah. Mm-hmm.
What?
Because
it's going to loan you $400,000 to buy a house and they're not going to make sure the house is worth $400,000 for it. What?
So here's the crazy thing. So because there's no loan, right? So he's just taking over the loan. Where the appraisal becomes the issue is if they do a second loan for the difference in the sales price versus the assumable mortgage. Plus, as someone that would buy a house, I'm just going to get the appraisal. So in my purchase contract, I'm going to say this deal is contingent upon the appraisal, right? The appraisal value. But yeah, I thought that was crazy too.
Think about the potential for fraud there, right? Like I come from New Jersey, Soprano land, right? Some guy buys a house at a 2.5% mortgage. He guts it. He sells the appliances. He rips out all the copper wiring and all the pipe. And now it's just basically a shell on the outside. And then there's some patsy that owes him money. So yeah, you're going to assume the mortgage and I'm out. I'm going to cash out. I already sold all the scrap value of the house and everything. And now they walk away with their money. The bank is screwed. The guy is screwed. I mean, there's just so much that could go wrong there. When he said no appraisal, I was just, wow, what's the worst thing that could happen? Don't answer that. That was quite shocking, I thought. Yeah.
Quite shocking.
By the way, I'm not advocating you do that. I hope that was not a blueprint for fraud. Sorry. Don't do that. Fraud is bad, okay?
We just got a little bit of an update on that UAW strike. I know you've been following that closely.
38 facilities. Oh,
Yeah.
So
it's hard for me not. Let me just talk about this real quick here. Let me open this up in another tab real quick. So, and then we come back to it. But here, I want to go into home building sentiment right now because the next video we're going to listen to how basically for the first 5, maybe 6 months of this year, home builders have been winning. But I think what's happening, Jack, and again, I went out in the field yesterday. I talked to these people. They're like, it's dead right now. I think what's starting to happen is these insane buying incentives, and I showed you that, like 4.25% fixed rate, like holy smokes. Price cuts, paying for closing costs. It's not working. It's not working anymore. They're just sitting there. So they have all of these amazing buying incentives, and they are amazing when we compare it to what you can get without that incentive. They're starting to get it. And I'm trying to tell people there's an an abundance of inventory right now, depending on the metro area, but overall right now in new home sales. I'm screaming this at the top of my lungs, Jack. But anyways, home builder sentiment goes negative for the first time in 7 months, thanks to the higher mortgage rates. Bidder confidence dropped to 45 from 50. Now 50 is the line between positive and negative. So this is kind of, the first time they're starting to get it. Now, let me play this video real quick, Jack, for everyone. This is going to go into home builder sentiment or basically what's going on with home builders. Then we'll take a look at that UAW, do a quick market review. I want to show people the hidden inventory, and then we'll end.
Joining us now is Seaport Senior Analyst Ken Zener. Ken, welcome. So, full year housing revenue more than expected, even though houses are going to sell for less than expected, they're saying. So if interest rates are staying higher for longer, can KB Home keep subsidizing that to drive its business even with prices coming down?
I think so for the industry in general. I mean, they are offering mortgage buydowns. Thanks for having me on. That do cost them a couple hundred basis points of gross margin, but that is creating the demand for them. So the key question for investors on KBH's call and for the home builders is, are they going to be growing, and what it's going to cost them in terms of returns, specifically gross margins? And I think that'll be a big focus on the call today.
At what point do homeowners who don't want to move have to move, either because of a job change or something, even if rates are staying high?
Right. I mean, death, divorce, job relocation tend to be the base dynamics for housing turnover, which is quite low, and it's still staying low at that 4 million. We do expect existing inventory to remain low and existing sales, which in our thesis, housing may not repeat, but it rhymes. Look, starting in the 1962 period, we do see higher rate periods, which we're in secularly, leading to low inventory. Builders traditionally gain share as a percent of what's for sale, and public builders specifically gain share using their balance sheet and mortgage buydown. So I think that tailwind will be benefiting KB and other public home builders.
So would you buy KB right now coming off of this print, or would you prefer to put your money to work somewhere else?
Well, I think, KB investors will want to hear about the gross margin guidance. The reason they beat in the quarter and raised the full year closing units is they are pivoting a little bit to pre-construction units versus their traditional build to order. And I think that's okay. I would say Lennar, who reported last week, is our top pick right now as it moves towards a capital light model where EPS equals cash flow.
Okay. So there's another thing that's been getting signaled and flagged among some of the home builders, and that's the fact that not only do you have high construction costs, you have high rates, but also land is becoming more scarce. Is that going to be a concern for KB Home too?
Land scarcity, I would say, is not an issue given the builder's own land supply that's available. You might see what's actually available for development there for sale impacting community count. I think we saw that a little with KBH, if I'm not mistaken. That's simply because they're selling faster. Clearly, land costs are going up. That's part of inflation. And the broader picture is real estate historically is an inflation hedge. So I think it'll all work out within their relative market share gains in the new construction business.
Well, historically, houses are a nice inflation buffer, if you will. I don't know at these PE ratios, though, Jack. I just I don't see it. I don't see it being a good hedge against inflation. What are your thoughts on new home builders right now?
First, my thought on that video is one of the reasons why I hate CNBC. That man said
Why?
nothing. He said nothing. He maintained a bullish. He maintained a bullish outlook on KB Homes, and then spent more time talking about negative things affecting KB Homes, and then just said, "But I'm bullish." And he said, "Oh, they've got land. Oh, they might gain market share. Gaining market share in a shrinking or even collapsing market is not necessarily good for business." He said nothing. So I don't know, is this guy shopping his own book? Is he selling what, or, is he trying to convince people to buy what he's selling, taking the other side of the trade? I don't know. But you never know. These guys talk out of both sides of their mouth. I have to say that one thing he said, that historically real estate is a hedge against inflation. All right, maybe that's accurate, but that is also irrelevant, because what the Federal Reserve is doing to fight inflation is crushing real estate. So in this environment, with Fed raising interest rates and quantitative tightening and people borrowing money on credit cards to eat, A home is the worst possible investment right now. So that was just awful, just terrible. We are all dumber having listened to that man. I'm sorry. Can I be any more forceful in my opinion of what was just said? That guy was terrible.
I'm so happy you're here, Jack. Sometimes I feel like I'm crazy, but yeah, man, these guys are out of their freaking minds, dude. I don't know, I'm screaming over here like these guys are on national TV. These guys, I mean, so this is a huge reason why I have so much empathy for the roughly 10 million Americans that purchased. I mean, I got to do some information to take out the cash buyers, but man, I mean, how are you going to blame these especially first-time homeowners when people aren't saying anything? They're just saying, I'm bullish. Home prices probably only go up. It's normally a great hedge against inflation. What about the P ratio, the payment ratio, and affordability? What about so many of these things? The fact that prices are only high right now because we have that super low inventory. So then let's think further. What happens when we get the inventory? Which brings me to my last part of this video. I'll go into rental. Now, I wanted to show you guys, I wanted to prove to our viewers, Jack, that there is a lot more inventory out in the field than what's being reported on the multiple listing service. Okay, so yesterday I went out to a new build community that was about 8 minutes from my house. And I was like, where the heck did this new building community come from? I mean, literally in Houston, Texas, there's new building all over the place. And I also want to make a point when I'm doing this next segment, Jack, that really one of the most important tools that we can use as consumers is the MLS, the multiple listing service. If we don't have access to MLS, we're at the mercy of Redfin and Zillow, and we already know we can't really trust their data, not 100% at least. So if you don't have access to this MLS, one of the ways to get access is by using a realtor. And I feel like it's important to understand, if it's me and I didn't have access, Jack, I'm using this as a way to interview realtors. So say I was in Miami, I'm calling like the top realtors like, hey, I need a market analysis. And I'll be honest with them. I'm shopping realtors. I want to make sure that I have the best realtor for the biggest financial transaction of my life. I don't want cheerleading. I just want data and I want a market analysis. Goodbye, right? This is vital. So I want to show you real quick. I'm going to put the year build. I'm going to change it to basically new builds, which is 2022 and 2023. I'm going to pull up a map and I want to show you something briefly. And this video is going to be out today. I love going outside, Jack. I love it so much because I hate being inside. But anyways, let's see what we are looking at. All right. So let me pull up the map actually. And I'm going to show you guys the community that I went to yesterday. Again, this is live data. I love the MLS. Okay. Let me show you this little community that I went to right here. So y'all see this community? Let me zoom in on it. Y'all see this community right here? Can you see that, Jack? See this right here?
Yep.
See, it says 8. So this is and look at, there's the lot right there. This is a new build community. I went to this yesterday. This is going to be our evening video. I hope you guys like it. I try to make it really nice. But this is literally 7-8 minutes from my house. I didn't even know it existed until a week ago. This is how much new building. Now, when I went there, I was like, I wonder if there's really just 8 homes. Jack, when I went there, after talking to the sales rep, they have 17 homes available right now. They have double the amount of inventory, more than double the amount of inventory ready to be sold. Double. And this is just one little tiny community. This is just one. Now, when I went there, I was like, okay, thank you, sales rep. But then I went to the construction zone area. Like I snuck in there. Actually, the sales rep was there first. So I turned around. She was so nice to me that I didn't want her to be upset. But when she left, I went back there and I counted 23 houses under construction right now. And they have an additional 180 they're going to build right here.
How many? I'm sorry. How many they're going to build right there?
180 more.
Slightly up from the 8 being advertised is what you're saying. Slightly.
Well, but I understand. Yeah. But I understand the 180 not reporting in there because they're not being in construction yet. But the fact that I go in there, I talk to them, I say, we got 17 options, but there's only 8 options on MLS. I mean, come on, and I'm trying to show our viewers this so they don't have to just listen to me. Right. So they can trust what we're saying. So when I go there, I'm like, here's MLS, here's boots on the ground. Y'all see that the inventory is 3 times higher. Okay. So I know that we have historically low existing inventory, but that changes when interest rates drop. The question is what's the buying demand going to do? And the last thing I wanted to show you is not only they're not reporting, the amount of competition that these people have is unheard of. It's absolutely unheard of. Let me see if I can show you. Okay, here we go. Let me show you. Okay, so here's the community. Okay, right here. Okay, so here's the community right here. You see that? It's the 8. Okay.
Yep.
There are 1, 2, 3, 4, 5, 6, 7, 8, 9. And if we count these, there's a lot more, but there's 9 additional new home building communities around this one. Did you hear me, Jack?
Yeah, and what's the
Did you
scale
hear-
here? Like what kind of a geographic radius are we looking at here?
Okay, so the mile's right here. Okay, so here's your mile. Okay, so,
Okay, so this is like you're talking like a 3 or 4 mile radius here. You have 8 neighborhoods under
Maybe-
construction.
I would say maybe, let's say not even a radius because I'm only going north. If I go south, it's even more.
Yeah.
Do you see what I'm saying? So this is like, what is a 10-mile northern radius, like a half a radius? You're the one in nuclear fusion. I don't know, is it 180 degrees or what are we looking at here?
Don't make
But
me
either
do
way, you
geometry.
see my point, man. You see my point here. I mean, there's freaking inventory in my market. This is not even looking at Houston. There's inventory everywhere. I don't have an inventory shortage. I have an affordable housing problem. Yes, I have an affordable housing inventory problem. But dude, if you want to buy a house, I got a 2,000 you can pick from. The problem is they're overpriced.
So
What do
there's a
you
lot
think-
of smoke and mirrors here, Travis, right? You got, first of all, they're buying down points and they're offering these incentives at closing, like that guy on CNBC was saying. Those are all things that artificially maintain home prices higher than they should be. So you've got the prices being artificially affected higher, and that is starting to show in the margins of the home builders because those things cost money. So the home builders are not making as much money because of that. But then you've also got artificial scarcity, or at least they're artificially inflating scarcity by understating how much inventory is out there. And you're pointing out here 8 homes, it's really closer to 17, 23 nearing completion, 108 planned. So they're artificially supporting prices with their shenanigans at closing, understating inventory because that's creating the narrative of a home shortage so that people keep paying these higher prices. It's smoke and mirrors in the housing market.
And we can prove this, Jack. Like I don't have to use my well, I get a little bit passionate. I understand that. I get passionate because I don't have my college degree like you. Okay, so I gotta compromise, right? Call it what you want. At least I don't drive a big truck. Well, it's a medium-sized truck. But anyways, I don't even know where I was going with that. But the crazy thing, Jack, I mean, but man, I mean, these are facts, right? And again, wait for this evening's video. Okay, watch this evening's video. You see right here, this is active MLS as of right now. You see 8 listings. This is BS. There's way more. And not only that, look at this. There's another freaking new build community right here. I didn't even know about this one until yesterday. Look at this. They cannot control that. I'm going to go out here also, Jack, and I'm going to check it out because look at this one says 9 listings, but I don't know. I have a feeling it is a little bit of little bit of dirt right there. I'm going to go out, man. I may go out there
If you come across
today.
an alligator in a pool, you need to send me a text message right away. That means, that's like the Big Short scene where okay, it's a bubble. Alligator in a pool, time to short.
Yeah, time to short it. But I mean, and then here's the other, new home build community. I mean, it is everywhere right now. These are facts, dude. These are 100% facts. So, I don't know. It is what it is. I want to go into our last thing real quick, which is the rental market. And then we'll go and take some Q&As. And I want you to talk, Jack. I really appreciate your time. I wanted to bring this up because, again, to Heresy Financial's point, where's the inventory going to come from? Prices are going to be stabilized because the inventory. But we also need to understand the quantitative tightening, right? The sheer amount of investors that have purchased real estate, whether they're good investors or mom and pop investors or foolish investors. I have a feeling that most of the recent investors are foolish, and that's no offense to them. It's just this market is absolutely crazy, and you don't know what you don't know. So no one knew what was going to happen here. But one of the things that I'm seeing is a hit in the long-term rental market. So not just the short-term. We're talking the long-term rental market. And first, let me talk about institutional investors. Again, you probably saw the Wall Street article that came out, I think, 3 days ago, talking about the leading institutional investors of SFRs are now net sellers, which means America right now is getting inventory from the institutional investors. That's happening right now. So that's a flip, right? So at one hand, they were taking inventory. Now they're giving us inventory. Now, one reason that is, Jack, is obviously the elevated interest rates, but also the rent growth is plummeting. And I just wanted to pull this up. This is from CoreLogic, okay? And look, actually rent growth did go down during the great financial collapse. A lot of people don't realize that. A lot of people are like, no, rent just went up during the great financial collapse. Well, that's not
Pay
exactly
attention,
true.
Airbnb owners. That dip right there, that's your business model collapsing.
Can you see the dip, Jack? Can you see this dip right? So we're not. What I wanted to point out is we haven't hit on a national average, depending on the data source. We haven't hit negative rent decline. I wanted to talk about that right now. Okay, we haven't hit it on a national average. We have hit it in several metro areas. One of them being in Austin. I believe Austin's down almost 3% year over year. This is huge. Rent going down is huge. There's so many portfolios, whether institutional investors, mom and pop, anything in long-term rental is going to suffer from a collapse in the rental market. And I wanted to show and point out, do y'all see the trajectory here? The trajectory is straight plummeting downward. And look at how close we are from negative. Here's the zero line right here.
Yep.
We're really, really, really close to being negative. Whoops, I hate when that happens. Anyways, so what are your thoughts there, Jack? Let me show you what fell down.
So it's important to note that that chart was a rate of change, right? So seeing that chart come down, and you did a good job zeroing in on that. But I think that's what a lot of people, some of the feedback I've gotten on my channel, when I talk about rent inflation coming down, I get a lot of pushback. Well, my rent didn't go down. All right. And it's hard because people are so passionate, because when your cost of living goes up and your wages don't, you get pissed off, right? You get upset. And when you say rent inflation is going down, you're telling people your pain isn't real, and some people react with malice to that. All right. Rent inflation coming down just means rent is going up slower. And we do have negative rent inflation in some key areas, as you pointed out, but on average, it's still positive. So rent is still rising, but it's rising so much slower. And the other thing to keep in mind here is that the way we track rent in the inflation statistics consumer price index was something called owner's equivalent rent. And you've talked about this a little bit on your channel too. That change in asking rents is not reflected in owner's equivalent rent, because all they do is they call up homeowners and they say, how much would you rent your home for furnished without utilities? And people spit out a number. That they're not checking Zillow, they're not checking Redfin or apartments.com. So owner's equivalent rent, the CPI statistic, is slower to react than that chart that you just put up there. So all other things being equal, if the oil price wasn't rising and everything else was unchanged, inflation over the next few months would fall dramatically just from the rental numbers catching up, because rent is 35 to 40% of the CPI math. So this is that chart you were showing, that is very disinflationary, not deflationary.
Right.
It's not prices going down, it's prices going up much slower. So that shows that the solution to higher prices is higher prices. People can't afford these higher rents. And so the landlords don't have the pricing power. They can't raise the rent anymore. So all these speculators who piled in while rents were rising, saying, I'm just going to borrow money and buy a house and then rent it out, thinking you'll be able to rent for higher and higher numbers. This chart shows that doesn't work.
Yeah, and that dip here, y'all, what Jack is basically saying, and this is why you haven't felt this, because this is disinflation, right? When it goes under the zero line, then we have deflationary trends, and that's really what the consumers want. Half the consumers, Jack, they don't care about disinflation because they want to feel the savings in their pocketbook, which only happens with deflation. I don't want to buy a house for $400,000 anymore. I don't want it. I don't want that house, man. It is what it is. I wanted to show you, Jack. Let me go to your story real quick, because I know that this is probably a good one.
Can I just make one more comment while you're bringing up the new story on the short-term rentals? We've never seen a short-term rental market go bust before. It's a new phenomenon. So with the Airbnbs and the Verbos and the bands and all the cities, we don't know what those short-term rental owners are going to do. Are they going to convert to long-term rentals? If they do that, it's going to suppress the rent. Or are they just going to sell the house? If they do that, it's going to suppress the home prices. My guess is it's going to be some mix, but we really don't know because this has never happened before. But either way, if the short-term rentals become long-term rentals, then they're going to lower the long-term rental prices. That's going to cause the institutional investors to sell their long-term rentals faster. It's going to translate into lower home prices eventually. but the order of operations, what shape that takes, is going to affect how fast it happens.
Have I showed you yet the sheer amount of Airbnb units in Dallas, for example, compared to how many active listings there are?
We talked about this a couple of weeks ago when you did a presentation on my channel. It was amazing. And Dallas, did they outright ban, or are they proposing a ban?
They straight up banned, man. Well, they banned it, Airbnbs or short terms from residential zoning areas.
Yes.
They banned that, dude. They straight up banned it. Let me put my password in here.
That means those short-term rentals, they're either making their way to the long-term rental market or the existing home sales market. They can't just sit there empty. People have payments to make. So where they go and how fast is up for debate, but they will have a deflationary or disinflationary effect on housing prices.
If I may, I want to get your reaction here. I want to just take in Dallas, if I may, Jack, real quick.
Sure.
And I want to get your reaction on this because, and the reason I want to bring up Dallas as opposed to any other area is because of the ban. A lot of people are looking at, oh, they're not doing well. Like, I don't care that they're not. I mean, I do care, but really the immediate challenge to the STRs, it's the bans. Like, what, I think people are looking at the wrong stuff, but I want to show you this, and I want your reaction. Let me throw this up on the screen. Okay, I'm going to Zillow first. Now, this is Zillow for sale homes in Dallas. Okay, right now in Dallas, there's 27 homes for sale.
That's a great picture there with the dumpster out front. Good job.
You like that?
That listing agent, yeah.
And it's only 833,000, so that's a great deal.
Yeah, let me just go ahead and buy that place.
Yeah, almost $1 million. Included? Well, I mean, you get this jagged pipe at least. I mean, the jagged pipe goes a long way sometimes. It's got some personality. Personality goes a long way.
Curb appeal,
Maybe 700,000, and I jump on that. But regardless, man, not a lot of homes for sale in Dallas. Okay, but let's say let's look at the rental market, because what if those STRs are just, oh my gosh, dang, the inventory dropped like crazy. Can't believe that. But look at the rental market. Only 2,039 homes for rent right now. See that?
These are long-term rentals, right? Yeah.
So we got what, a total of 4,700 active units,
just
under or
just over 4,800 combined. Yeah.
Okay, and it's important also to note that again, to Herschel Finance's point, the inventory is one massive reason why these prices are even elevated. So now that we know about 2,700 and 2,000, so 2,000 and 2,000, let's now go to AirDNA, which, by the way, you guys can sign up for this. Now, first of all, remember, they've banned Airbnb. It is not legal to operate in residential zoning areas any longer in Dallas, as of right now, Jack. Okay, and I'm going to show you how to do the math on this. But it's saying right now, STRs right here, this counts VRBO as well, 10,100 units.
Wow.
In Dallas right now, where, by the way, again, just to put, really drill this home, illegal. We need inventory. There's 10,100 units, but I don't want you to get lost there. You got to scroll down a little bit. You got to go by listing by rent type, and you have to see the total percentage of entire homes. Because 89. 89, dude. 80. So, but I don't want you to take rooms because it won't get you the right data, right? So we got to go 10,100 times 89%. Do you see what I'm saying here? Okay, 9,000 freaking Airbnb. I'm sorry, STR, because look at right here. It shows you 65% Airbnb, 8% VRBO, and then 27% both. So this is pulling from VRBO as well. This is a great tool if you want to see what's going on in your metro area. Jack.
So there are 4 times as many short-term rentals in Dallas that are now basically illegal as there are long-term rentals available. 4 times. The short-term rental market, if you combine the existing homes for sale with the long-term rental market, you have twice as many Airbnbs and Verbos as you have that whole market combined. The market cannot absorb those numbers. I had no idea the extent of it, Travis. My God.
I'm trying to tell people, Jack, they don't listen, dude. They want it like, if it doesn't happen in their state, you're wrong about everything. No. Let me. Why don't we look at? You want to give me an area? Maybe it doesn't have to be in your area. Why don't we look up an area around where you're at? You want to give me like a zip code or something? Or
all right, let's do like a suburban area. Do King of Prussia, Pennsylvania. All right, that's like a
Oh my
high-end
God.
suburb of Philadelphia.
Okay, I'm with the slow reading group. I got lucky. Okay, here we go. Let's see how many there are. Only 73. Is this a small area?
Uh, it's mostly a commercial area. Maybe that's not the best example.
Yes.
But whatever. It's the one we picked. Let's see what we get back with there.
So we got 73. Is that residential?
And these are the short-term listings, right?
Look at over here. Look at Philadelphia. Yeah, these are short term. Look at
Yep.
Philadelphia. Can we look at Philadelphia instead?
Sure.
Thank you. Thank you. Let me put how do you spell Philadelphia? Here it is. Dude, it's
Philadelphia.
filthy Delphia. Look at this. Okay, so Philadelphia, 9,600 active STRs. Jack, that's pretty crazy, isn't it? How many houses are up for sale in Philly?
I couldn't tell you.
It was a loaded question, I'll be honest.
I don't have my almanac
You don't have your
queued up in my brain at the moment.
All right, let's see. All right, that's rent. Let's go and switch to sell. All right, so we got 65 and 65 in Philly. Okay, that's interesting how it's that close. So we got 6,500 homes for sell in Philly, and we have look at that, it's crazy, isn't it? 6,500 homes for rent.
So not as bad as Dallas, but Dallas is kind of a boom town, right? It's one of those rapid expansion areas. Philadelphia is not. There's no build out in Philadelphia. Philly is built. It's an old city. But still,
Right.
short-term rentals 1.5 times the size of the long-term rental market, 1.5 times the size of the
Take a look at
existing
this.
sale
And
market.
this is why you have to be careful because look at entire homes only at 60%, 68% here.
Okay,
Isn't that
so
interesting?
that puts you
Way
down
lower.
pretty close to the size
Yeah,
of the
that's
market.
way
Then
lower.
probably
That
about
means to me that
5,500.
means that there's like less space and people are renting out more of their houses. It matches. Look at that, Jack.
Yeah.
It matches. There are as many STRs as there are rentals and homes for sale. But if we get a 50% come up in inventory, are you kidding me? Do you know? I mean, the effects of the market. I mean, I think it would have profound impact. But anything you want to add before I go into the UAW? We've been talking.
I'm just checking right now to see if there is a short-term rental ban in Philadelphia. As Philadelphia cracks down on unlicensed Airbnbs. Yep.
No way.
26th of this year. So, that's another city where that's happening. So those are heading to market. Absolutely. One way or another, they're going to end up on the rental market or the sale market.
So when people ask me, Jack, oh, where's the inventory going to come from? Okay, well, I've listed 8 different where's the for selling going to come from?
Yeah, I had no idea the Airbnbs were that big relative to the inventory in the market. That's amazing, Travis.
Isn't it? Okay, so I'll shut up. This stuff is the type of stuff that gets me crazy excited. And honestly, man, I was one of the first people that, and I did this on a live video, not on an edited video, that was like putting this together. I was like, you guys look at the listings compared to the total amount of STRs. It's freaking nuts. Oh, you guys may remember that live. Not sure, but here's a UAW if you want to comment on it. UAW targets the 38 facilities at GM. Blah 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 blah.
See if you don't mind, could you see how many additional workers are we talking about? Because 12,700 at 3 facilities was the existing strike. Now there's a lot more facilities here, but it looks like they might be going after the parts supply chain. If I had to guess, let's see.
Distribution location.
Parts distributors. Yep.
Good call.
I don't see anything about the number of workers being added.
Yeah. I don't see that. Let me scroll. Let me keep scrolling. Nope, doesn't give us a number.
So we don't have the number 38. It's parts distributors. My guess is this is probably going to be roughly a doubling of the number of employees.
Wow.
I don't know parts for which vehicles. The nuclear option in this is the F-150. If the UAW targets the Ford plant where they make the F-150s, that's when, oh boy, this is going to be a big deal because that is the bread and butter for Ford. And that means they're going after the big hit, right? So they're still, I don't want to say tiptoeing, but they're still not fully committed to the fight if they're doing this. Now, going after the parts supply chain, that's going to cause a lot of minor problems, a lot of headaches, but they're still holding back the big guns. So we're probably looking at more bickering, more bantering, more negotiating. This is going to go on for at least another week now, probably 2. But watch that F-150 plant, man. If that goes on strike, there's going to be movement in the market on that.
Yeah. And it's not going to be good depending on what side of the fence you're on, obviously. All right, man, let me let's wrap this up, Jack. Let me take some questions if I can. I was only able to get a few because I was just so locked into this episode today. I really hope you all found it valuable. Again, like the video, go to Jack's channel, Nobody Special Finance. This is my dude right here. Obviously, he's a nuclear scientist. I didn't even go to college except for 2 semesters. But Jack, I'm doing the best I can, man, and I'm really good at math. I'm really good at running data reports, and I'm really good at telling people what not to do. So that's got to count for something.
Yeah. We can tell you got kids. Don't do that. Don't do that. No fighting. Don't eat that. No hitting. Yeah? That's being a parent, brother.
I know, man, and my humor is so cringe, and I understand that. Now, here's a comment from Hawk. When you recommend putting down, when you recommend putting 20K down after closing to save the mortgage, what's the benefit of doing this rather than adding $20,000 to your down payment? It's important to understand that it's way different than a down payment, because your down payment, after you put your down payment, you close on a 30-year loan, okay? Which means after you close, the amortization starts. And that's why you can't do it until you've got the loan. So in certain situations, and I'll have to do the math on this again, in certain situations, it makes more sense to put that money towards your amortization schedule versus more money down in certain situations, because that's how bad those amortization schedules work. But obviously there'd be a difference in payment that you could put towards bi-weekly payments. But the thing is, you have to put it directly towards your principal. You can only do that really after that amortization schedule starts. Thought I had one for you, Jack. Something you should talk about is the cost of living. I watch you every day. Thank you, Omega Fed? Student loans. How about childcare? I pay $1,200 in childcare load. Oh my gosh. Childcare is brutal. I was a single father when I first moved to Texas. This is before I met my wife, and we have 3 children now. I had a son, still have a son. I love that little guy. And I was a single father, and I had nothing when I first got to Texas. And I got to tell you, man, like, I worked for 2 reasons, Jack. I worked to put food on the table, and I worked to pay for my not child support. One more time, I didn't get no child support. You know what I'm talking? I was a single child care. I have. It's just another reason why I have empathy, man.
Yeah.
Childcare is just. Go ahead.
Childcare is basically college now. It costs as much as college cost a few years ago. And especially when you first have a kid, you know, those first few years until your kid is in first grade and doing a full day at school, pretty much, you're going to be eating that cost. And that is, you know, assuming both parents are working. I would say reevaluate the second job. It's hard. Being a stay-at-home mom or stay-at-home dad is a brutal profession. But, you know, really look at what is the gain of having both parents working with a childcare cost that much, and also factor in incidental costs of working, because you have to buy more work clothes, you have to commute, you have to have a second car. So really scrutinize the expense of that second job and do a cost benefit, not to mention the effect on your kids of being raised by somebody else.
Yeah.
So, I mean, there's other benefits that are hard to quantify there. There's other things you can look into, like a lot of employers these days are offering childcare FSAs or flex spending accounts, where you can put up to $5,000 or so of pre-tax income into a dedicated, it's a use it or lose it account in the year, but you can pay for childcare with pre-tax income that way. That can save you about $1,500 a year if you were to do something like that. We do that, my wife and I, because my wife's employer offers that. You can use that to pay for private school. You can use that to pay for summer camps. You can use it to pay for childcare, for medicine, or co-pays for kids' doctor's visits. As long as it is proven for the benefit of the child, you can use childcare FSA money for that. So that's one way you can chip away at that cost.
Childcare FA, what was it? FSA?
FSA, flex spending account. It's basically, it comes out of your paycheck and it goes into an account that can only be used for approved childcare expenses, but you never pay taxes on that money.
That's
now,
huge
the
benefit.
rub there is, don't lose it at the end of the year. Don't, oh my God, it's March, and if I don't use it in the next week or two, I'm going to lose it all. Then all of the benefits of that account go away. So you have to, there's a discipline required, but it's a very powerful tool for minimizing your childcare costs. See if your employers offer that. And if they do, make the most of it. Use every penny of it.
100%, man. I mean, childcare is rough on a lot of these people. Here's another good question. My realtor told me it could take up to 6 months to qualify for an assumable mortgage. I don't know any seller that would wait that long. And that's a huge point I try to tell people also. Like, remember I said, like, assumable mortgage, you got to qualify for. I don't know that it takes 6 months. I thought it was 2 to 3 months, but that's why, like the video we listened to, that company exists to help with these transactions and processes. But yeah, it's no slam dunk. It's no slam dunk. And here's another thing on assumable. Even if the seller offers an assumable mortgage, yes, the buyer has to qualify. It's really important to understand that. And then there's another. I took 3 with assumable. Another problem with assumable mortgages is the second loan, if you can't come up with the 20 or 25%, will be 7 or 8, 9%. Better than your first mortgage being 7 or 8, 9%, though. But he's right. You know, that is going to have an additional burden. Those are all the questions. I don't know if you guys have any more questions for Jack. Throw up some questions if you have any. I'll take a couple more questions. We've been really a long time on this live. I really usually don't go this long. But if you guys have questions for Jack, shoot him up there. He knows about nuclear energy. He's very smart, probably. Do you know calculus?
I've been through calculus. I couldn't do it to save my life right now.
If you guys have some calculus questions or whatever it is you want to know, anything about really anything, just let us know. If not, I'm gonna get out of here. Let's give it a minute now. Jack, anything you want to say about what we covered today before we go?
The thing about the home builders and that thing on CNBC really rubbed me the wrong way. How he was just basically like, my boss told me I have to be bullish, KB Homes. I don't know why I'm bullish, but I'm bullish. Pay attention to that, guys. That shows you how desperate they are to keep this thing inflated just a little more. You're blowing the gum bubble, right? There's a hole popped in it. You have to blow so much harder to keep that thing inflated at the very end before it just collapses and gets gum all over your face. I see them blowing harder, all right? Trying to sound bullish when really all he just gave you was reasons to not be in those companies. All these gimmicks they're offering to maintain the higher prices, it's squeezing their margins, the deceptive inventory numbers. My God, the Airbnbs, Travis, wow. I had no idea I knew the problem was there. I had no idea the scale of it. Good God.
Yeah. What about the hidden inventory? I'm trying to give people overwhelming value, Jack, because you came in. Remember you said like one of the things inventory. I was like, Jack, let me show you something, Oh, by the way, have you ever watched In Living Color?
Yes. Fire Marshal Bill.
Are you?
I'm a volunteer firefighter also, so I know Fire Marshal Bill. Yep.
You know Fire Marshal Bill?
Let me show you something.
You guys, if you don't know Fire Marshal Bill, check this out.
I know what you're thinking. We're all perfectly safe in this classroom, right? Right. Wrong. Just about everything you see in here is a potential hazard. Let me show you something.
I'm sorry. I've been waiting to play that for like 5 days. I just never found the perfect moment to. So thank you for participating in that.
Early Jim Carrey. The Cherub of Justice was another great one of his characters on Living Color. The little
I love that
he
show. That's such a great show. So I got a couple questions. We'll get out of here. First one's from my man Kayleen. How soon after the correction should we jump in to buy homes? I have my own answer there, and I'm a little disappointed in this question. But Jack, what do you say?
Last time, don't quote me on this, but I believe it wasn't until like 18 months later that prices actually bottomed out nationally after, we'll say Lehman Brothers was the start. Don't quote me on this, but I think it was about 18 months before prices bottomed out. It wasn't until like mid 2010, I believe, is when we actually saw the bottom after the GFC. So be patient. You're not on the clock here, guys. This is an important decision with a lot riding on it. No FOMO. That's what I say. No FOMO.
I'm going to say this, and I know you've been watching me, so how dare you ask that question, sir? That depends on you, and it depends on when you find your great deal, and it depends on your goals. Every market's different, right? That's what I'm saying. Use your MLS. I want to challenge every single person that is watching right now. I have a challenge for you. I have 2 challenges for you. Over the weekend, I want you guys to rebudget. And when I do my Monday live, I want you to come back on our Monday live and tell me how much money you saved. All right. Again, challenging you. You better 2 things. 1, I'm telling you guys, please, for the love of all that's holy, please listen to me. Please rebudget. Please rebudget. You will save money. I'm almost guaranteeing like 90% of the people that are watching right now would save hundreds of dollars a month if they did that. Now, the second thing I challenge to you guys is start interviewing realtors and have them do your market analysis, because if y'all don't have access to MLS, you're at the mercy of the corporate world like Redfin and Zillow. So please listen to me. I challenge you, start interviewing realtors. Don't go buy a house. I never say go buy a house. But I got a couple more really good questions, and we're going to get out of here. What do you this one's for you. How do you think the oil prices increasing will reflect on interest rates? Obviously, that would increase inflation. What do you got, Jack?
Yeah, oil prices right now, the trend is driving inflation higher. As inflation drives higher, it causes interest rates to rise as people expect a higher return for loaning money, as they expect it to lose value over the course of the loan. So oil prices will put upward pressure on interest rates. Oil prices will also cause the Fed to be more aggressive to try to contain that inflation, which could lead to more quantitative tightening, more rate hikes. And the other thing, oil prices, right now, people are putting gasoline on the credit card, right? People can't afford higher gas. People are already going into debt. So people will borrow more money to be able to pay for the higher gas. That's going to increase the demand for money, which will increase the price of money. The price of money is interest rates. So interest rates higher from oil any way you look at it.
Okay, second question is, are you going to watch my evening video where I'm giving you some boots on the ground and showing you inventory?
Me?
Yeah, you.
Yeah, I'm going to watch it.
All right. Okay.
I love the
Here's-
walkthroughs. And they are absolutely bonkers, Travis.
You know they're bonkers, Jack. Not as bonkers as some of these other things that people are saying. Here's a nuclear physicist question for you. Will we ever, Jack, have fusion?
Fusion has been 50 years away for 50 years. That's the running joke in the nuclear industry. If you don't know, fission is what we do at nuclear plants now. We split uranium atoms, also a little bit of plutonium. We split the atoms to release energy. With fusion, we do the opposite. We take two atoms and we smush them together to form one atom, and that releases even more energy, typically without any of the radioactive byproducts. It's very hard to do. Fusion is basically trying to create a little star on Earth. We have been able to do it. We've made advances. We are now able to do it in small amounts where we get more energy out than we put in, but we can't sustain it yet. So it's still years and years away from being done sustainably in a lab. And then once we do that, several more years before we can do it on a commercial scale that's actually putting power on the grid. So fusion remains 50 years away, unfortunately.
I put that up as a joke. Didn't expect a solid answer like that. I learned some stuff right there, and it was scary. Last question, Jack. Okay, so we got a question. Why are other channels saying rates didn't change? But answer that question with the rates from yesterday up. Okay, so here's the rates from yesterday going up 14 basis points. Why are other channels saying rates didn't change yesterday? What do you think, Jack?
It looks like rates did change yesterday.
I don't know why they wouldn't say. Yeah.
We'd have to ask those channels. I'm not sure what their basis is, but sure looks like rates changed to me.
Well, I would say they not only changed, they actually skyrocketed to almost a new record that was set in August 20th at 7.49%. I suspect it's going to be higher, but let's look real quick. I just wanted to end this last thing, and let's look at the market real quick, just since you're here. So VIX, ooh, look at that. Look at it, just reverse course. The VIX did. So the market's like, you know what? Here's the 10 years. Okay, so the 10 year went down about 5 basis points. The market's sending it, Jack. Market is sending it. Says nothing, no worries here. Maybe no concerns here. The VIX is plummeting.
You know, the VIX has not really performed its role this year. A lot of people there's this phenomenon called zero DTE. People are buying stock options that expire on the day they buy them, 0 days to expiration. And the fact that so many people are messing around in these short dated options, it's having an effect of artificially suppressing the VIX. So I don't have a lot of confidence in the VIX as the indicator that it's meant to be. VIX math is very complicated, but I know that zero DTE, people trading in short-term options, is suppressing the VIX. So don't read too much into that data point, at least not in this environment.
All right, brother. Well, I'm gonna go ahead and end this, but again, I want to you go ahead and close this out, Jack. I just wanted to tell everyone we really appreciate you following along with us. We really hope that you're learning. Obviously, some of these titles are clickbaity, but that's just how, unfortunately, and it drives me freaking crazy, Jack. I hate it so much. There's a couple things that drive me crazy about being a YouTube influencer, the biggest one has to be the titles that we have to come up with. So I'm sorry, guys, but understand in our videos, we try to create overwhelming value. We just play the game of media, and it is what it is. And I absolutely love you guys for watching this. I want to, again, listen to what I'm saying. Everyone that's watching, you need to listen to what I'm saying. I'm challenging you over the weekend. I want to hear back from you on Monday on our live about how much money you saved rebudgeting. Please don't let it go in one ear and out the other. I'm telling you this because I am almost certain you will save more money than you expected. And then also I'm challenging you to please get with the realtor, start using MLS data because it's that freaking important. Please, you guys, I want to be proud of you on Monday. I'm already proud of you and I already appreciate you, but we need to grow together. I'm growing, Jack is growing, but a good teacher, right? We bring them with us. Jack, closing lines here, sir.
Travis, thank you so much for having me on. There's never a dull moment on this channel. I always enjoy our talks. And thank you so much for the information on the short-term rentals. Wow, that I had no idea. No idea. You blew me away with that one. Awesome stuff. So thank you so much. And thank you everybody for watching. Give Travis a like. It really helps him out with the algorithm, and subscribe to his channel if you're new here. Thanks, brother.
And yeah, of course, man. And if you're out there investing in real estate, you know we wish you luck and we hope you win.